Hello, everyone, and welcome to the day 2 of the Master for September webinar series for the FM paper. We had met yesterday wherein we had a quick revision. Can you people quickly let me know what area of the syllabus did we revise yesterday? And we also practiced the past paper questions. Quickly, which syllabus area was it that we had revised yesterday? Yes, we had revised business valuation. So that was on our agenda for the yesterday's session. Now, today we are going to get started with the day 2 agenda. In case you people want to be connected with me after the webinar also, these are the contact details shared in front of you. This is my direct contact number on WhatsApp, and you can alternatively scan on this QR code to directly send a message to me. Now, moving forward, we had covered the day 1 agenda in yesterday's session. We had revised business valuation and we also practiced the latest past paper question together. On our agenda for today, we will be revising investment appraisal. So we all know this is a very important syllabus area and nearly certain to be tested. In which part of your paper? Which section of the paper investment appraisal gets often tested? I had told you people this yesterday. Yes, this is a section C question. Very often the investment appraisal is tested in the section C of our FM paper. So this is what is on our agenda for today. Day 3 and day 4, which will be for the enrolled students at BeingACCA, we are going to have a revision of the business finance area of the syllabus. And then day 4, we are going to move towards the grand revision, which will be a 2-hour, one-shot revision of all the concepts that we've studied as part of the paper. Now, getting started, before I do that, just a quick reminder that the revision boot camp at BeingACCA is open for the September quarter. So as part of this, you will get to attend the remaining 2 days of the webinars, which otherwise are only for the enrolled students. And you also get to have 2 of your mocks evaluated from me. All of this is available at 1599 INR. If you want any further details, my contact number is mentioned over here. You can reach out to me on this number. Now, getting started, are we ready to revise investment appraisal? This entire unit, which you people have studied, very important from the section C perspective. Are we all ready? Shall we get started? Yes or no? Show me some energy, guys. Can I get some more responses? Come on. You've all had a Sunday. I hope it was a holiday for everybody. So you've all replenished yourselves, enjoyed, got some energy back for the coming week. Yeah. Okay. So let's get started with revising investment appraisal. So the main area that you learn over here is that investment appraisal simply means business has limited money and that money needs to be invested in different projects which the business can earn profits from. Now, there are so many different projects, but the money which the business has is limited. So which investment project would be the best for the company? That is what we learn to decide as part of this unit. And this unit teaches us multiple techniques how we can find out whether the investment is good for a company or not. And one of the techniques which we started off with, when the syllabus is taught to you people, the very first technique is the payback period. Can you guys in very simple words let me know what's the meaning of payback period? What do we mean by payback? Come on, let's make this participative. This is a live session, so let's make it a two-way interaction. Yes, it's the time that it takes for you to recover your initial investment. Faster the payback, the better it is, or slower the payback, the better it is, guys. What is the scenario? Faster the payback, the better it is for the company. Very good. So what is the formula that we have studied? You keep on accumulating the cash flows and you see that until which time frame are we able to recover the entire investment back. The decision rule is pretty simple. There is a target which the management has set. So for example, the target is to recover the money within 3 years. And if a project comes to me and tells me you will get your money back within 1 year. So do you think I should invest in a project like this? My target is to get the money back within 3 years, but this project gives me faster within 1 year. So yes, I will go ahead. And if this number is greater than 3, then I will reject the project. So very simple decision rule. You people, I'm sure, have also covered the advantages and disadvantages. It's simple to calculate, easy to understand, and we're focusing more on the early cash flows because the more further we go into the future, uncertainty increases. So if you're focusing on early cash flows, that means the business will be able to have a greater liquidity position. Further disadvantages are also there. We are ignoring the cash flows that happen after the payback period. So we are not considering the complete project, the target which we are setting over here in the decision rule. This is set by the management. So it's subjective. And one more problem is that we are ignoring the time value of money. But this problem we overcome. Can you guys let me know how do we overcome this problem? We've developed another technique which overcomes this problem of payback period not accounting for the time value of money. What is that technique which overcomes this problem? Come on, quickly give me the name. Yes, it's the discounted payback period. Very good, guys. And one more disadvantage is that it does not give you any change in the, it does not tell you how much the shareholder wealth is going to change. So this is a quick revision of your payback period concept. Now, moving forward, one more technique of investment appraisal which we have learned is the ROCE method. ROCE is also called as accounting rate of return, and it is also called as return on investment. This is a formula which you people have been studying for a very long time now. What's the formula? You simply take the profit that will come from the project and you divide it by the investment. If the question tells you to take the average investment, then how do we calculate the average investment? It's simply initial investment plus the scrap value divided by 2. And how do you make the decision is also very simple. There's a target which the management sets. If your ROCE, can you people quickly let me know, higher the ROCE, the better it will be, or lesser the ROCE, the better? Yes, higher the ROCE, the better it will be. So if my target is lesser and the ROCE which the project is giving me is higher, then I will accept the project. Otherwise, I'm going to reject the project. Advantages are pretty simple. I get the information which I require for this calculation. It's very easy to get that information from the books of accounts. It's simple to calculate and understand. And this is the method which financial analysts all around the world very commonly used. So even when I am deciding which shares are the ones in which my clients are going to invest their money, I also see the ROCE metrics. It's one of the most important metrics that we look at. Then, if you talk about the disadvantages, different methods are possible. Sometimes we take the average investment, sometimes we take the initial investment. So because of those different methods of calculation, we may not be able to always compare the numbers for one company to another company. Another thing is that it is based on profits rather than cash flows. And we all know profits, they are a book number, they are a figure that comes from the books of accounts, which can very easily be manipulated. We can go for window dressing or different accounting policies if we use the straight line method or if we use the written down value method. Guys, can you quickly let me know if I calculate depreciation using straight line versus using the written down value method, do both of the methods give me the same amount as depreciation? No, I get different amounts of depreciation. So due to changes in policies, my profit figures can also differ. One more thing that we have as the disadvantage is, again, here we are not considering the time value of money. The target, again, that we are comparing is set by the management, which is subjective. So I may make some mistakes. The management may be biased in setting this particular target. And one more thing is that this is a relative measure. What do you mean by relative measure? Your ROCE answer is always in a percentage. Now, if you get a percentage, this tells you how much return you will get on your investment. But do you get to know how much your shareholders are going to increase in their wealth? Absolutely not. So this is the disadvantages that we have studied as part of the ROCE method. So far, so good, guys. Payback and ROCE, you're all with me? Everybody, yes or no? Everyone, can I get some more responses? You people are lacking on energy today. Okay. Now we've studied that the money has time value because of these three reasons. What are the three reasons? First is the liquidity preference. Investors prefer to have money right now in their hand rather than having it in the future. One thing is the risk. The more further we go into the future, the more the risk increases. So if I'm getting money today, I will prefer it because 10 years later, I don't know what is going to happen. So many things can change over 10 years. And one more thing is inflation. So the best example is any chips that you probably used to purchase in your childhood. Now they cost you more for the same amount of chips that you could purchase earlier. So your money loses its value because of inflation. Now to get that same packet of chips, you have to pay more amount of money. So your money has lost its value. For those same chips, you now have to pay more money. So these are the three main reasons we had studied why money has a time value. Then we have studied the two main techniques which are used for the investment appraisal, which is the NPV and the IRR. Now, can you people quickly let me know if in any circumstance it so happens that NPV gives me the answer that I should accept the project and IRR gives me the answer that I should reject the project. So what should I do in that scenario? Who should I listen to, NPV or IRR? Who should I listen to? NPV, because it's considered as the most superior method of investment appraisal. NPV will always give you the right answer because it tells you directly how much the wealth of the shareholders is going to increase. So NPV is an absolute measure. It tells you in exactly dollars. So if you're getting a $10,000 answer, that means taking up this project will simply add $10,000 to the wealth of your shareholders. Whereas the IRR gives you the answer in the form of percentage. So it's only a relative measure. That means if I know the IRR, I can just know how much return percentage I will earn, but I do not know how much will be the exact money that gets added to the wealth of my shareholders. Secondly, the decision rule we have already revised that NPV, whenever it will be positive, we will accept. Whenever NPV is negative, then we are going to reject the project. Similarly, how do you decide when it comes to the IRR? When it comes to IRR, we have to compare it with the cost of capital. If the IRR is greater than the cost of capital, return is more, so then I accept the project. If my cost is more than my return, then definitely it does not make sense to go ahead with the project. Further, we have studied that NPV directly tells you how much the shareholder wealth will increase or decrease because of taking the project, but IRR does not show you that absolute change. And when it comes to the reliability, NPV is always reliable and IRR, sometimes it can give you multiple conflicting answers. So can you guys let me know under which situation is it possible that for a same project, you'll be able to calculate 2 or 3 IRRs? For which sort of projects it so happens that we are able to calculate 2 or 3 IRRs for the same project? Yes, it's the projects which come with the non-conventional cash flows when we see multiple reversals in the flow of cash. What do we mean by multiple reversals? Usually, what will you see in a project? Usually, you will give out some money in the first year and then 1, 2, 3, 4, 5 years, the money just keeps coming in. So it's one time only that cash goes out and then it just keeps coming. But sometimes there are such projects that in year 0, you are paying money. So it's a negative cash flow. In year 1 and 2, money comes in. But in the third year, again, you have to give out money to get money again in the fourth and the fifth year. So here you can see first there was an outflow, then inflow, then outflow, then inflow again. So multiple times the cash flow is reversing. Sometimes it's in, sometimes it's out. So this is what we call as multiple reversals. So for these projects, which we call as unconventional projects, it's possible that we are going to get multiple IRRs. So if that is the case, decision making becomes difficult. You do not know which IRR should you compare with the cost of capital to find out the answer, whether you should accept the project or you should reject the project. So in such scenarios, which method do we prefer? We always prefer to use the NPV method because it will always give you the most accurate answer. Okay, so this is a quick comparison between the NPV and the IRR methods. So far, so good, everybody. Do you all follow? Whoever it is who is drawing on the screen, please ensure that you do not do this. We are no longer in the 5th standard in school that you will be pulling off such moves to distract the flow of the webinar. If I see you doing this again, you're going to be removed from the meeting. Okay. So now moving forward, guys, we have studied that there are discounted cash flow techniques. So some of the methods that we have studied, can you people quickly give me the names of the methods that we consider as discounted cash flow techniques? NPV, IRR, discounted payback method. Yes, these are the techniques that we say are considering the time value of money. So we call them as the discounted cash flow techniques. So we've studied that these techniques come with these advantages, that they take into account the time value of money, when the money is coming in, and we are also most importantly covering the entire life of the project. So this is an advantage. And here we are using a more objective basis for evaluating. Objective means NPV. We do not have any decision rule of our own. We do not have any set targets. The rule is simple. If the project itself comes with a positive NPV, then you accept it. Otherwise, you reject it. So the way that we are coming with the decisions, that is more objective, involving less of personal bias and opinion. Then if you talk about the disadvantages, it can be time consuming to calculate the NPV and IRR. It can be complex to do the calculations. These numbers might be difficult for us to explain to a person who does not come from a finance background. One more thing is that it may be complex to find out the discount rate. So for NPV, we need a cost of capital or a discount rate to calculate the NPV. So if I have an unlisted company, a company which is not listed on the stock market, maybe I might find it very difficult to know how much their cost of capital looks like. And then if I talk about the fourth point, that is the managers may feel that the connection with the discounted cash flow techniques and their bonus system is very little. So what do we mean by that? Usually, guys, if you, whatever theory that you people have studied and whatever you may have seen practically also, can you guys let me know on what basis usually the managers get their bonuses in any company? To decide the bonus of the managers, on what basis is it decided? Performance. So in performance, I'm asking the metrics. What are the numbers used to decide whether they're going to get the bonus or not? Profits. Sometimes it can be on the sales. If they're a sales manager, so a percentage of the sales. Yes, absolutely sales and profits. Now, is it very common that we see that NPV is the metric against which the bonus will be decided? No. So the managers feel a disconnection. I am trying to get a project which comes with higher NPV, but does it give me a benefit in my bonuses? No. My bonuses depend upon sales and profits. So as a manager, my psychology will be to look for those projects which will increase the sales, which will increase the profits. So this creates a disconnection between what the managers are looking for versus what is actually good for the company. So these are the advantages and disadvantages that are associated with the discounted cash flow techniques. You all follow till here, everybody? So far, so good? Yes or no? I see a lack in responses today, guys. Okay. Now, moving forward, the key assumptions that are there as part of NPV, which you people should remember while you are doing your calculations. Usually, if nothing is specified in the question otherwise, the investment that you are doing, initial investment, goes out in year 0, which is right now. If I talk about the finance cost, can you people let me know any interest which the company is paying? Do you account for that interest in your NPV calculations? No. What is the reason? Okay, Harshal says irrelevant. Jayati says non-cash, but you pay the interest in cash? Yes, Arya is absolutely right. It is already included in the cost of capital, or what we call as the rate of discount. So that is why we never take interest as a separate calculation in the NPV workings. And the third thing which you guys should be careful of when you're solving NPV questions is the timing of the cash flows. So whenever you're plotting anything in your NPV calculations, example, this is what your format looks like. Okay, so any number which you are putting down between, in this year two column, what does this mean? That this cash flow happens, can you guys let me know, beginning of year two or end of year two? If I'm putting a number below 10,000, below the year number two, does it mean beginning of year two or end of year two? Yes, it is always at the end of year two. So in case a question gives you a scenario that we are making the payments in advance. Payments in advance means for year two, you are making the payment at the starting of year two. That means under which year will you put that number? If it's starting of year two, you will put it in below year one. Very good, guys. So please be very careful with the timing of the cash flows. These points which I'm telling you guys right now, these are the areas where students commonly make the mistakes and lose the marks in the paper, right? So this is something which you people should be careful about. Harkirat says, what if the investment took place in beginning of year one? Will it arise in year zero? Absolutely. If it's the beginning of year one, you cannot put it below year one because that would mean end of year one. So you have to put it 1 year before that. What is 1 year before year one? That is year zero. So that's the logic why we put the initial investment under year zero. Okay. So far, so good. You guys recollect these three things that you have to be careful for, everybody? Okay. Now, moving forward, some adjustments which can be there as part of our NPV workings. Number one is sometimes it might be possible that the inflation which is given to you in the NPV adjustments, it can be of two types. Either the question will tell you one single general rate which is applied to all items, which will be applicable on revenue also, which will be applicable on variable cost also and fixed cost also. So in that case, one single rate you will apply on all numbers. But sometimes it can happen that the question will give you multiple rates which are specific to different items. So there the question will tell you revenue, or you can say the selling prices will increase by 2% every year. Variable cost will increase by 5% every year, and then fixed cost will increase by 10% every year. So if this is how the question is giving you the information, then you have to be careful. Whatever inflation rate has been told for whichever item, you have to specifically keep using those particular interest rates for the items as they have been specified in the question. Okay. Be careful about this thing. And one more thing is, in the question, it can tell you that the cash flows which are given to you are real cash flows or they could be nominal cash flows. So what do you people say? If the question tells me that these are real cash flows, is inflation included in real cash flows or not? Do real cash flows include inflation? No. And if I talk about nominal cash flows, is inflation included over there? Yes, it is. So accordingly, you people have to make the adjustments. If already the nominal cash flows are given, will you put inflation again? Will you put inflation again if nominal cash flows are given? No. And if real cash flows are given, then the rates of inflation are given, then we will apply the inflation in our workings. So this is something which you guys should be careful of. Now, having a quick recap of what all we consider as relevant and what all is considered as irrelevant. So we have studied that there are majorly two of the costs that we consider as relevant. One is the incremental and the second is the opportunity. What is the meaning of incremental costs? Very quickly, guys. What do we mean by incremental? Yes, it is a cost which is incurred directly because of the project. Specific for it, additional expense which the business is only incurring because of the project. So if I have to purchase a machine just because of taking up this project, then it will be called as incremental, and incremental costs are always considered to be relevant. And what are opportunity costs then? What do we mean by opportunity costs? Yes, it is the cost of your next best alternative that you forego. So if, for example, you were getting the choice that if you work at company A, you will get a salary of $50,000. If you work at company B, you will get a salary of $75,000. So obviously, you are going to go for the second option if everything else remains the same. You will opt for company B. So what is the next best thing that you are foregoing? That is $50,000 of salary that you are foregoing to achieve the salary of $75,000. So this 50,000 will be called as the opportunity cost over here. Further, if I talk about the things which we never consider to be relevant, one of them is sunk cost. So sunk cost is that cost which has already been incurred by the company. So if the company has already paid for something, for example, you did some research about a project before taking it up. Now, the money that you have spent for the research is already spent. Whether you take up the project or not, that money is not coming back. So the money which is not coming back is called as a sunk cost, which will never be considered relevant. Then you have committed cost. What's the meaning of committed cost, guys? What does committed cost mean? Committed is the English language word. So committed means doing a promise to somebody. So you have already promised to someone that you will pay them $100,000. Now, whether you take up the project or not, you have to pay this money. So this also will not be considered relevant for our calculations. And thirdly, the cost that are non-cash flow. So any depreciation, any amortization, basically anything which does not involve inflow or outflow of cash will not be considered relevant for our calculations. So these are the things which you people should remember while you are dealing with what all numbers you will put in your calculations and what all has to be excluded. Then one more place where they can give you an adjustment in the long 20 marks of calculations is the working capital. So the working capital, we know that the workings are very simple. When does the initial working capital leave the company? Under which year do we show initial working capital? Usually, if nothing else is specified, it goes out in year 0. And in the later years, so if I ask you people, the requirement of the company looks something like this. So for the first year of operation, the business needs $10,000. Second year of operation, the business needs $15,000. And third year, all the project is basically coming to an end. So can you people let me know which number should I plot below year 0? What number should I plot below year 0? In my NPV workings, I will show minus 10,000 as the initial investment. So this is the working capital that I will show in my final answer. So I'll show minus 10,000 over here. Then if I talk about the very first year, what number should I put over here? 5,000 plus or minus? Give me complete answer. Negative? Guys, this is the thing which I'm telling you above. This is the requirement of the company. This is the amount of money which the company needs for the working capital. So if in the year 1, for the year 1 requirements, you have already given them 10,000 for the initial working. Now in the second year, they need 15,000 in total. So how much more money will you give them? You will give them 5,000 more because the 10,000 will come back at the end of the year. So now they need 15. They already have 10. So you will take out 5,000 more from your pocket. So now tell me, will it be a minus or will it be a positive figure? Guys, if you still stay positive 5,000, then your concepts are extremely very weak. You have to go back to your concepts again. Minus 5,000 is what I will put over here. And when at the end of the second year, because the project is coming to an end after 2 years, in third year, I have no requirement. So what will the cash flow look like at the end of the second year when the project has come to an end? I will get my entire 15,000 back. So here my answer will be positive 15,000 because this all money which I had invested in the working capital, this all comes back to the company. So my step number 2 is that in the later years only I will record the incremental investment, and then if there is any inflation which is required, I'll charge that inflation, and then in the last year all the money that was invested, that is all going to come back. So far, so good, everybody. Are we all clear? Okay, great. So now moving forward, one more adjustment that it can test you upon is about the taxation. So what are the different ways in which the adjustments can be there with respect to taxation? The very first thing is on the basis of the discount rate. So you guys have to be very careful. If at all the taxation is given in the question, taxation rate is given to you that the company pays tax at this particular rate, then you will always account for taxation workings in your solution, and at the same time the discount rate that you will use will be the post-tax discount rate. But sometimes it can also be possible that the question tells you you have to ignore taxation. So if you have to ignore taxation, no rate will be given to you. And then which cost of capital will you use? Will you use the pre-tax rate or the post-tax rate, guys? Yes, if the question asks us to ignore taxation, then we will be using the pre-tax cost of capital. Okay. And one more thing where I see majority of the students losing their marks, that is in the working, the WDA calculation, the written down allowance. So this is the place where I see the majority of the students losing out on the marks. So in the last year, it is very important that rather than charging, do we charge depreciation in the last year, guys? Can you quickly let me know? No. So in the last year, what do we have to do is we have to calculate whether the company is going to get a balancing charge or will they get a balancing allowance. So what do is we compare what is the value according to our written down value according to our books, and we compare it with the disposal value. So if there is a gain, then the company has to pay a charge. And if the company loses out on money, if for example, according to my books, the value of the asset was $10,000, but I had to sell in the market for $5,000. So in this case, have I made a profit or a loss, guys? According to me, something that was worth 10,000, I had to sell for 5,000. So I have ended up making a loss over here. So what will be the case? Will I have to pay a balancing charge or will I receive a balancing allowance? Yes, I am going to receive a balancing allowance. Very good. So this is how we are going to do the adjustments which are related to the taxation part. Okay, so far so good, everybody. You all follow till here? Is everybody clear with me? Okay. Now moving forward, we know that is it possible for the business to invest in all projects that they want to? Does the business have infinite amount of money? No. So that is why we have studied the concept of capital rationing. What do we mean by capital rationing? It's when the business has limited amount of money, and because of that, the company has to wisely prioritize where they are going to invest their money. Now, this capital rationing, why it happens, the reasons can be of two types. One is where it happens because of external factors. That means when you go outside of the company, you ask banks to give you money, and then they tell you, no, we will not give you money, we will not lend you a loan. So which sort of capital rationing will we say the company is facing in that scenario? that will be hard capital rationing. And if the management themselves are saying, we can go to the bank and take a loan, but we do not want to take a loan. We do not want to have that obligation that constantly we have to keep paying the interest. So which sort of capital rationing is this then? This will be soft capital rationing. Perfect, guys. And one more thing is the type of capital rationing can also depend upon the duration. So if the periods, how the companies classify the period can be different from organization to organization. Maybe at my company, I classify one period as 1 quarter. So if the business is facing a limitation in the funds only for 1 quarter, then I would say that this is single period capital rationing. And if it will last for 2 quarters, 3 quarters, then I'm going to say that this is multi-period capital rationing. Right? So these are the classifications that we have studied. And then some of the reasons also which you people have studied before, hard capital rationing. That means outsiders are telling the company, no, we will not lend you money. So what could be the reasons? The business may be heavily risky. The business may already have a lot of debt with them. Maybe I'm operating in a country where there's a lot of political risk. It's an unstable company, war-torn area. So then outsiders won't lend me money. Or the outsiders do not know reliable information about me. Only I am telling them the information about myself when they try to go to ask somebody else. How is this FM company who wants to take a loan from us? They do not get a lot of information. So then it would be difficult for them to trust us. So these were some reasons for the hard capital rationing that we had studied. And then soft capital rationing. That means internally, the management is setting the restrictions that we are not going to, borrow money from the market. Maybe we'll not take a loan. Maybe we don't want to give equity to anybody else. So a reason could be that I want to grow slowly, organically, rather than, rapidly increasing via promotions and advertisements. One is the management does not want to dilute the ownership. So if I issue equity shares, so whoever purchases equity in my company becomes a part owner of my company. So I don't want anybody else to become the owner. That is why I'm not going to ask for equity investments from others. Sometimes if I'm saying no for taking debt, that may be because I do not want to have a fixed commitment of paying a certain amount of interest every month. And one more reason why the managers will put in place such a capital rationing is if they want to create an internal market for investment funds. What do we mean by that? We know that if the top management has put a limitation that the company only has, let's suppose, $100 million to invest. So, there are different managers sitting at the lower levels of the company. Imagine there's manager A, B, C, and D. Now, if the management has set a limit, maybe they have equally divided the money between these 4 managers, 25 million each they are all getting. So now these managers, they within themselves know that the maximum amount of money which the company will give to me in my hand is 25 million. So now these managers will automatically be more careful to invest in those projects which are actually good for the company. When you have something in a limited quantity, you value it more. So if you talk about how much water is kept at your house and versus if you compare it with how much gold you have with yourself. So the gold which you own or which your parents own, they keep it very carefully because you know that it's expensive. It comes, you have very less of it. But water, it's widely available. Sometimes it even keeps dripping. The tap remains open. So that is how, if something is in limited quantity, we care more about it. So that's the same reason the management wants to give a message to the managers that we have limited amount of money, use it wisely, invest it in areas which are actually worthy of investing the company's money into. So these are the reasons that we had studied for the hard and soft capital rationing. So far, so good, everybody. You're all with me till here? Okay, great. Now, moving forward, we had studied that if the company is facing different types of investment projects in front of them, then the strategy, how the money will be divided between different projects, will also differ. So, there can be two types of projects. One is a project which is divisible, and one is a project which is non-divisible. So, can you guys quickly let me know what do we mean by divisible projects? What's the meaning of a divisible project? Yes, the project which you can take in parts. So you can choose how much proportion you want to invest in. I can take 20% of the project, 10% of the project, 5%, 70%, 80%, how much ever I want to. And then we have studied that there are non-divisible projects. So like the name itself is telling you, is it possible to divide a non-divisible project? No, a company will either take entire project or nothing at all. So this is all or nothing. So if you are having the first category, your projects are divisible projects, then you are going to calculate PI, that is profitability index. And what is the formula? You simply take the NPV and divide it by the initial investment. And then you calculate it for all the projects and then you do the ranking. Whichever project gives you the highest PI, you give that the first ranking and then you go in the decreasing order. And once you have completed your rankings, you start to allocate the funds in the order of that ranking. So whichever project you gave the first ranking to, you will allocate the money to that project first, and then you will follow the rest of the ranking. So this was what we do for the divisible projects. And if your projects are non-divisible, that means it's an all or nothing project, then what do we have to do is we do not use PI over there. Then we will simply do a hit and trial method. So hit and trial means I will try what all are the different possible combinations. I will do all the calculations that if this is the combination, this is the money that the business will earn. So then I will identify what all combinations are possible. And lastly, I will select that particular combination which gives the business the highest amount of total NPV. So this is how the money will be bifurcated depending upon what is the type of the projects that are available to the company. So far, so good, everybody. You're all with me till here? Okay. Now, moving forward, one more decision which we learn as part of the investment appraisal unit is about the asset replacement. So we know that sometimes in the organization, it may be possible that the company wants to keep repeating the use of one asset again and again. Now you want to keep using that asset for 50 years, 70 years, but you know, the machinery, it keeps getting old. So maybe it's a delivery van. Now you know that your company has to get the goods delivered from the factory to the customer premises. So every time you need a van for as long as your business wants to continue. But the delivery van comes with an expiry date. 2 years, 3 years, it works very well. After that, it may start to get old. It may start to consume more oil than before. So then you have to replace the van. You have to purchase a new one instead of the old one. So how long until you should wait to do the replacement? That is what we learn under the asset replacement decisions. So a company may have an option. You can replace the van after every 3 years. You can replace it after every 4 years, after every 5 years. So how do we do the calculations then? We simply calculate the NPV for all the different options. So if let's suppose the company has two choices, either they can replace after every 3 years or they can replace after every 5 years. So what will company do is they will calculate NPV for both options. One is after 3 years, one is after 5 years. Now, you people let me know, will it be fair to compare two NPVs, one where the project duration is 3 years and one where the project duration is 5 years? Do you think we should compare them as it is? No. So how can we make them comparable? How can we ensure that they can be compared? Yes, we will calculate what we call as the EAC. That's the equivalent annual cost. And how do we do that? You take the NPV that you had calculated and simply divide it with the annuity factor. So whatever is your cost of capital, so you go to the annuity tables, look at the cost of capital and whatever is the duration of the project. So if, for example, the duration of the project is 3 years, so you go to the 3-year table and then you check how much the annuity factor is, take the NPV, divide it with that annuity factor, and that is going to give you the equivalent annual cost. And now, since this is the cost which the business is comparing, can you people let me know which option should the business go for? Lower option or higher option? Lower option, because this is where we are talking about the cost. So cost, the business will always want lesser, but sometimes this can be about a project also where the business is making an investment. So there you are talking about a benefit. So then when you're talking about a benefit, which option will you pick? Higher benefit or lower benefit? Higher. So you people have to be careful what exactly the question is talking about. If it is a cost, you will select the one with the lowest EAC, and if it's a benefit, you will select the highest option, right? This is what we had studied in the asset replacement decisions. And further, one more decision which we take with the help of the concepts which we have learned over here is the lease versus buy. So you know that the businesses, they may require some sort of machinery, some sort of asset to be used in the company. So in that case, the businesses may have two choices. Do we purchase the machinery completely on our own, or do we take it on a lease? Guys, what do we mean by lease? What's the meaning of lease? Yes, taking it on a rental agreement. Yes, absolutely. So you have both the choices. Should we take it on a lease? Should we buy the asset? So then again, you do a lease versus buy calculation. In buying, what all are the cash flows that are relevant? First is the purchase cost. So when you buy, you will have to give all the money up front. And whenever you sell the machine, the scrap value is also something which you will get. And then definitely when you are buying the machinery, it's your own asset. So on your asset, you will charge depreciation also. And because of that depreciation, you're going to save on taxes. So you will consider the tax benefit also. And on the other hand, if you're taking the machine on a lease, the lease payments that you make, the rent that you pay, what is the rent for a company? It's an expense for a company. And whenever the expenses are increasing, guys, what will happen to the profits of the company? If there are more expenses, the profits will fall. So if your profits are lesser, will you have to pay more or less tax? If your profits are lesser, you will have to pay lesser tax. That means because of having these lease payments, you will also get some sort of tax benefit. So the amount of tax which you will save because of having this expense in your books of accounts, that is also a number which we will take in our calculations. So these are the numerical things which we will consider as relevant. Apart from that, there are also some of the non-financial factors that even if numerically you are finding out that leasing option will be cheaper for the company, still the company may prefer to buy the machine without having a look at the reasons that are given over here. Can you people let me know what could be some of the reasons, even though leasing is cheaper, but still the company is buying the asset? What could be the reason? Okay, the project may have a higher resale value. You want to have absolute control of the asset. You want to use the asset for a longer term. Okay, great. So then you will prefer to buy. And can you give me some of the reasons why you will still, lease the asset even though buying is cheaper? Okay, you want to use for a short term. Maintenance is high, maintenance is difficult. Yes, okay, because you want to access the latest technology. Great, great, perfect. You want to have specialist support. Very good, guys. So these are some of the non-financial factors that we had studied, why the businesses will prefer buying or leasing, even though the other option makes financially more sense. Okay, do you all follow till here? So far, so good, everybody? Can I get some more responses? Do you all follow till here? Okay. So now we move forward towards one more area which is there as part of the investment appraisal unit, that is about risk and uncertainty. So can you people quickly let me know, risk and uncertainty, do these two things mean the same thing? No. Right. So risk is what you can measure. You can quantify risk. You can put it in the form of numbers, but it's not possible to quantify uncertainty because we have historical data for risk and we do not have any historical data about uncertainty. That is the main difference. Then we have learned how the businesses can include risk and uncertainty in their investment appraisal. One of the techniques that we have studied is the sensitivity analysis. So in very easy language, what exactly is the meaning of sensitivity, guys? Sensitivity analysis, what is the crux behind this? Yes, absolutely right, Kartikeya. Here, we change one variable at a time and we see that if this variable changes, how much this variable is going to change such that it will make the NPV zero. Right? A project may have a positive NPV, but maybe if the revenue falls down a certain percent, then the NPV can go to zero. So then this sensitivity analysis helps the business calculate by how much percentage the revenue will fall and then the NPV will come down to zero. So this is the sensitivity analysis. What's the formula? We take the NPV and we divide it by the present value of the variable. So if I ask you people, I am getting for one variable the sensitivity, let's suppose for the volume, the sensitivity is 3%. And for the selling price, let's suppose the sensitivity is 5%. So can you people let me know which variable is more sensitive? Yes, the 3% variable is more sensitive. Why? Because a small change will make the project fall to zero. So a smaller change would be sufficient to bring your value down to zero. That is why that variable is more critical. It is more sensitive, right? So this is the meaning of sensitivity analysis. And remember one thing, if the question asks you to calculate the sensitivity of sales volume, you people have to consider the contribution. And if it asks you to consider the sensitivity to selling price, then you have to consider the revenue figure. Okay, this is something which you people should remember. This is one area which I see students commonly losing marks in. So far, so good. You people are clear till here? What's the biggest limitation of the sensitivity analysis? You can see a list of limitations. What's the biggest limitation over here? Sensitivity analysis, what's the biggest problem? Yes, absolutely right, Jayati. The biggest problem is you can only change one variable at a time. But what do you guys say? In the real world, is it possible that all things will remain constant and only one thing will change at one time? Is it possible in the real world? No. In the real world, multiple things keep changing at the same time. So what is the solution? If sensitivity analysis can only change one variable at a time, is there anything else which we can do to change multiple variables at the same time? Yes, that is simulation. So this is the Monte Carlo simulation. The numerical part of it is not a part of our syllabus. As part of our syllabus, we are only expected to know what are the stages in the process and what are the advantages and disadvantages. For the calculations, you need very sophisticated supercomputers, models, advanced technicians who are going to run these simulations. So quick revision of what the process is. The very first step is we will specify the important variables. So for any business, any project, revenue, costs, profits, these will be the important variables. Then the second step would be to specify what is the relationship between those variables. So relationship means putting it together as an equation, basically. So I can simply put it as profit will simply be equal to revenue minus the cost. So this is how I have specified the relationship between the three variables that are important to me. Further, the third step would be to attach the distribution. So what I will do is, for all the different variables that I have identified, I'll tell the computer what is the probability of having how much percentage of revenue. So 50% chances that my revenue will be 5 million, 20% chances that it will be 8 million, and 30% chances that it will be 6 million. So here I have given the probability of the different variables. Fourthly, now my computer is going to generate random numbers for my cost, for my revenues, and then they will see how much the profit is going to be in all different scenarios. This, the entire simulation, I will keep on recording the outcomes, that if this is the cost, this is the revenue, this is how much the profit will look like. So we will keep recording the outcomes and we will repeat the simulation multiple times. So for a lot of number of possible combinations, we will see that if this is this way, then how much the profit will be. If this variable changes, how much the profit will be. So multiple times we keep running the simulation, we record the outcomes, and then we try to find out how much is the probability of earning how much amount of profit. So these are the main steps that go behind the Monte Carlo simulation. Now, what are the advantages? The advantages is that I get more information about what all outcomes are possible and what are the probabilities of those outcomes happening. One more advantage is that I can use the data to calculate the expected NPV. Expected NPV means including the impact of probabilities. But then it does not come with only the advantages. There are some problems also. Monte Carlo simulation only can give you extra information. It does not tell you whether you should take a decision or not. So it will not help you in decision making. It will only give you extra information. It is very time consuming. It is expensive. And if this Monte Carlo simulation, this will only give you the correct result if the input that you have fed to it is correct. So what is the input that you are feeding to it? The probabilities that you gave for your revenue, cost, your profit, the assumptions which you have used. So if your probabilities were wrong, if your assumptions were wrong, then the final outcome that you calculate using a simulation would also give you the wrong answer. So these are the advantages and disadvantages that are associated with the Monte Carlo simulations. So far, so good, everybody. You all follow till here? Yes, everyone? Yes or no, everybody? I see very few responses. Okay. Now, moving forward, one more technique to build in the risk and uncertainty in our investment appraisal is the technique of expected values. So here, the formula is very simple. You take the value of the outcome, multiply it with the probability of that outcome happening, and then you sum all of it together. So here X will be the value of your outcome and probability will be probability of that outcome happening. So if, for example, 50% chances that your answer will be $2 million and 50% chances that your answer will be $3 million. So how do we calculate the EV? It will be 50% multiplied by 2 million plus 50% multiplied by 3 million. So the answer will give you the expected value, right? This is how simple the calculation is. Advantages is that if you have multiple information with you, it becomes difficult to make a decision, but expected value will give you one final answer. So with one final answer, you can take decisions easily. And one more thing is that expected values are easily understood by everybody. Further, if we talk about the disadvantages, it's difficult to estimate the probabilities accurately. When they are directly given to you, it's very easy to calculate. But in real life, when a company actually wants to use these probabilities, it might be difficult to find out the probabilities. Another thing is whatever average you get. So for example, if you do the calculation over here, this will come to 2.5 million. So in reality, what is going to happen is either your final answer will be 2 million or your final answer will be 3 million. Is there any outcome where your final answer will come out to 2.5 million? Is there any outcome where your final answer will be 2.5? No, your final answer will either be 2 or it will be 3. So this is the second disadvantage, that the average may not correspond to any actual outcome. This average of 2.5, the final answer will either be 2 or it will be 3. Nowhere will you get the final outcome where the answer will be 2.5 million. Another thing is that EVs cannot be used in one-off situations. Why? Because you need probabilities, and probabilities can only be generated when something happens multiple times. When something is repeating over and over again, then your probabilities become more accurate. But something which is only happening for the first time ever, then EVs cannot be used for that, because you won't have probabilities for that. Further, if you talk about the fourth disadvantage, it ignores risk. So we are not seeing the spread of the possible results. So let me give you one example about that also. Let's suppose there are 3 outcomes which are possible: 50, 30, and 20. And the chances look something like this. This is -1 million, this is 2 million, and this is 4 million. So now how are we going to calculate the expected value? 50% of 1 million. So this is minus 0.5 million, plus 30% of 2 million will be 0.6 million, plus 20% of 4 million will be 0.8 million. So when you add all of these together, you're going to get 0.9 million positive as the expected value. Now, in reality, guys, what is going to happen? Either your answer will be 0.8 or it will be 0.6, or you can also have a loss of minus 0.5. But if you guys do not know the workings that were going behind this number, but you only just know this number, will you guys even have a thought in your mind that there are chances of making a loss over here? Will you have a thought in your mind that it's possible to make losses? No. So this is what the last limitation is talking about, that we are ignoring risk. We do not get to know. There is no indication about what is the spread, how much the results can actually vary. I am seeing a positive 0.9 million as the EV, but there are even chances of making a loss of $500,000. So this is what the last disadvantage is telling us about. So far, so good, everybody. You all follow till here? Everybody is with me? Okay. Jayati says, does sensitivity help in decision making? You people let me know. Sensitivity, when you calculate, do you get the help? You just get to know whatever variables are important for you. What variable is a critical success factor? Yes, it can only give you information. It's just additional information, but it does not tell you that this decision the company should take. Okay? Yes, absolutely. This is one of the limitations that we have studied. Now, moving forward, the last thing which we are revising from the investment appraisal unit is the methods that the companies can use to manage the risk. So if the company is very worried that we are facing so much of risk, how do we deal with this risk? Then these are a few methods they can use. Firstly, they can set a maximum payback period. So they can have a policy at the company that any investment which comes with a 5-year more than the payback period. So if 5 years is the maximum payback period that we will accept. So any investment which has a payback period higher than 5 years, we will not accept that project. So what will happen is, if you're setting this maximum payback period, any project that maybe returns your money after 10 years. So you know that more the duration, the higher the risk is going to be. So automatically you will invest into those projects which have slightly lesser risk. Another thing which the company can do is use a higher discount rate. So you all know what happens to the PVs as we are increasing the discount rate. What happens to the present value as we keep increasing the rate of discount? PV keeps falling down. So if you are using a higher rate of discount and still the NPV is positive, then that tells you even if your cost of capital increases, still the project will give you a profitable return for the investors. So this is just to be a little bit more on the careful side, that the company can use a higher discount rate if a project is more risky. Thirdly, we can try to use conservative forecast. What do we mean by conservative? We try to be careful when we are doing the forecasting, when we are trying to do the predictions. So if I'm predicting my revenue for the future, I should predict it in a manner that I am not overestimating my revenue and I'm not underestimating my cost. If I am thinking that my cost will be $1 million, let me just put it as $1.2 million just in case there are some emergencies, some extra payments that I have to make. So this is what we mean about conservative forecasts. Then we should go for those projects which come with a lesser standard deviation. So standard deviation means how much your actual final answer will differ from the answer which you have calculated. So for example, I have calculated 0.9 million. How much my final answer can differ? Either it can be, one project has a very high standard deviation that my answer can be huge positive, can be huge negative, or another project which will deviate very less from the figure which I know about. So businesses should prefer those projects which come with lesser standard deviation so that there is still a degree of predictability. The business knows that the loss won't be way too much. And last but not the least, another thing which the company can do is keep a focus on the CSF. So under sensitivity analysis, we get to know what are the factors which are the critical success factors, which are the things which can, even a small change can make a big difference to the company. So we should keep a clear focus on that. We should keep the management attention on that so that the business is taking care of the things which actually matter. So these are a few methods that we have studied how the business should do the risk management. So far, so good, everybody? Do you all follow till here? This was a quick recap of the entire unit of the investment appraisal. Did you guys enjoy this? Within a span of few minutes, we have revised the entire unit of investment appraisal. Okay. Now, moving forward, before we head towards the latest past paper practice, I'll, briefly navigate to switch my screen to the ACCA practice platform. Before I do that, I would just like to give you people a few things that you should take into consideration, keep in mind while you are trying to solve a Section C type question. Number one is always read your requirements very, very carefully. Before you dive into the case study, before you read the case study, the first step that you should do is read the requirements first. So why am I telling you this? Usually the students will read the case study first. Now, it's such a lengthy case study. All the information that you are reading, you do not retain all of that. So when you read the requirement after you've read through the case study, so you know that this is what the requirement wants you to do. So till the time you read the requirement, you've already forgotten what was there in the case study. So to save on time, it's always good that you read the requirement first. So then when you are reading through the case study, you know exactly what you are looking for. You know what answer is expected out of you. Second thing which I would want you people to keep in mind is keep highlighting the key information while you are reading the case study. So while you are reading, keep your highlighter open. I'll show it to you people on this the practice platform also, how I will do it. So while we read the case study, we will simultaneously highlight any information which is important, which we might use later. Thirdly, very important for the discussion questions, specifically, whatever answers you are drafting, they must be according to the marks that are available, the depth that you are answering, the length that you are answering your requirements. It should be properly as per the marks available. So if a question carries 6 marks and you're thinking to write 3 points, so that means every point you are aiming to get 2 marks. So at least the point should be explained in 3 to 4 proper, well-framed sentences where you are exactly explaining what the examiner has asked. Further, usage of subheadings is extremely very, very important. Whenever there is a possibility, it's possible for you to use the subheadings. Ensure that you use them. Put the subheadings in bold, leave a line, and then explain it in 3 to 4 sentences. It improves the presentation of your answers and makes it easier for the examiner to mark your answers. Moving forward to the fourth tip, that you should always write your answers in short paragraphs compared to long essays. Trust me, guys, nobody wants to read long essays. The more easy you make the job of the examiner to mark your answer, the easily they will be giving the marks to you. So please do not write your answers in long essays. Use short paragraphs, 3 to 4 sentences in one paragraph. If you still want to write more, change the paragraph, switch to the next paragraph. And one more thing, last but not the least, is the time management. So you people should be very, very careful. Section C questions carry 20 marks each multiplied by 1.8. 36 minutes is the maximum amount of time which you should be spending towards the section C one question of your paper. Okay, so these are a few tips that I want you people to keep in mind. Any queries, any concerns still here, guys? What if the theory question is of 4 to 6 marks? Do we still have to write 2 to 3 sentences? So Pia, it depends upon the number of points that you're writing. So if, for example, the question carries 4 marks, and you are thinking to write 2 points. So then you are trying to get 2 marks for every point that you are writing, then you have to write 3 to 4 sentences. But if for a 4-mark question, you are writing 4 points. So then that means for 1 point, you want 1 mark. So that the explanation will be in 1 to 2 sentences. This is just a general rule that I'm giving to you. You have to see it scenario to scenario also, right? Whatever is the requirement of the question. Okay, generally, this is the rule that you people can follow. All clear, everybody? Should we move towards the ACCA practice platform? Are we ready for question practice, everybody? Okay, so allow me a moment while I switch my screen to the practice platform. Okay. Can you guys give me a quick confirmation if now you people can see the practice platform on your screen? Okay, great. So this is the very first question that is published as part of the March-June 26 past paper. On our agenda for today, we are going to solve this question together. And then day 3, I've already told you people, we will be revising the business finance unit. I was seeing that some of the students were asking, when are we going to revise the other areas of the syllabus? So grand revision is going to include the revision of all the areas of the syllabus, entire syllabus in one shot. And I would also tell you people to check out the same webinar series that I had conducted for the previous quarters, wherein I had revised the other areas also as, in the day 1 and the day 2s of the sessions. So I would definitely urge you people to check out the previous recordings also. I had conducted Master for June, Master for March. So do visit those recordings also. They're all available on the YouTube channel of BeingACCA. Very important resource. I would say it would really help you in your preparation. So do check that out also. Available absolutely for free, of course, on the BeingACCA YouTube channel. Okay, so let's get started. This is the question in front of us. What should be my first step, guys? Very quickly, let me know. What should be the first thing that I do? Yes, I should be reading the requirements first. So I can see over here, the very first requirement for 10 marks wants me to evaluate on financial grounds whether AgeAid should buy or lease the vehicles. You should show clearly how all the costs mentioned are treated. So whatever costs are mentioned over here, my workings should clearly show how I am treating those costs. So this is a 10-marker question. I have to basically, this is a question on lease versus buy. Information will tell me I have to do my calculations and then I have to do the evaluation. So this is what I'm supposed to do for 10 marks. Let me see further. Part B carries 4 marks and they want me to discuss 2 reasons other than the present value of the cost why AgeAid should lease the vehicles rather than buy. So just now we had revised these factors. You guys remember 4 marks, 2 reasons have been asked. So for every reason, you have to write explanation that's worth for 2 marks, right? So how many sentences at least there should be in our answer? At least 3 to 4 sentences. Yes, absolutely. Now moving forward, the part C carries the remaining 6 marks of this question. And here I have to explain the 3 E's framework and how this can be applied by AgeAid. So can you people let me know here, do I require a generic answer or do I have to write a case specific answer? Will I be able to score the marks if I write a general answer simply explaining value for money framework? No, I have to make my answer linked to the case study. And how did we get to know it's the name of the company that's mentioned in the requirement? So now I know that my examiner wants me to give a tailor-made answer for AgeAid. If I write a generic answer, I will not be getting the marks. Same goes for the part B also. Can you people let me know general or case study based answer over here? Yes, here also it will be case-based. Absolutely. So now I know what exactly the question wants me to do. Now the next thing that I will do is get started with reading the case study. Do you people have any queries, any concerns, anything which bothers you people till the requirements? Requirements are clear? Everybody? So far, so good? Okay, so now we move towards the case study. So AgeAid is a charity. Okay, this is something which I will highlight. Charity means they are not operating for a profit purpose. So, the ratios will not be relevant for them. It's the value for money framework which will be used to evaluate their performance, which provides a number of services for the elderly, including day centers where they can attend and participate in various activities. AgeAid is funded by donations, government grants, legacies, and surpluses from the shops which it runs. Its services are mostly provided by the volunteers. AgeAid is planning to introduce a scheme providing regular hot lunches to be delivered to participants' homes. To do this, it will need to invest in specially adapted vehicles. The charity's trustees are currently considering whether to buy or lease these vehicles. As a charity, AgeAid is exempt from tax and therefore cannot claim for tax allowable depreciation. So can you people let me know, will we be considering any tax implications over here? If the charity does not have to pay taxes, then they will neither pay taxes nor they will get the tax benefit. So this is something which is very, very clearly given to us. Then the options, the information about both of the options has been given to us, information regarding the buy option and information regarding the lease option. So what I will do is I will get my working sorted over here. I have to compare 2 options. First, let me do the comparison for the buy option. I can see that this project runs until 4 years. So I'm just plotting down my number of years and then let me read the information. So the vehicles could be bought immediately for $300,000. Immediately for $300,000. That means this is the purchase cost. Maintenance costs are forecasted to be $12,000 in year 1, increasing by the following rates in the subsequent years. So annually, this is what the maintenance costs will keep on increasing by. So that means in the second year, it will increase by 20% of the amount of the first year. In the third year, it will increase by 30% and fourth year 40%. Other running costs would be assumed to be 20,000 in the year 1, increasing at an annual rates of 5% each in the years 2 to 4. Accounting depreciation would be charged on the vehicles. So far you people keep letting me know. Firstly, if I talk about the purchase cost, relevant or not when we are considering the buying option? Purchase cost, relevant or not? Relevant. Maintenance cost, relevant or not? Yes or no? Relevant? Then if I talk about the running cost, relevant, yes or no? Again, relevant. If I talk about the depreciation, relevant or not? Depreciation, relevant or not? Not relevant? Can you people also give me the reason why you are saying that this is not relevant? Yes, depreciation is a non-cash item. Definitely, guys. So accounting depreciation would be charged on the vehicles at an annual rate of 20% reducing balance. The vehicles would be assumed to be disposed at the end of year 4 at a residual value equal to their carrying amount. So depreciation I do not need to include in my workings, but there is one number which I have to calculate and include in my workings, because of which I'll have to do the entire workings related to depreciation. Can you guys let me know which number is relevant to me, because of which I'll have to do the whole working? What number? Yes, that will be the scrap value, because we know that whenever we are evaluating the buying option, initial purchase price as well as the scrap value, both are the numbers which are relevant for my calculations. Shall we get started with the workings? The last line gives me the discount rate also for 9% that we have to use. Should we get started with the workings for the buying option? Yes or no? Okay, let's get started. So the very first thing which I see relevant over here is the initial purchase price. So initial cost. Now initial cost is directly given to me $300,000. Can you guys let me know under which year should I plot this figure? I should plot this number under year 0. So year 0 minus 300,000. Okay. Yes, 300,000. Now the next thing that I will do is I will have a look at the second item which is given to me as the maintenance cost. So maintenance cost. Now maintenance costs are forecast to be $12,000 in year 1. So can you guys let me know under which year should I put $12,000? Yes, it will be under year 1 because we'll be paying this money at the end of year 1. So minus $12,000. And then this will keep on increasing every year. So this number will increase by 20%. So 1 plus 20%. So this is how much what we will enter into the year number 2. Now, can you people let me know what should I enter for the third year? What should I enter for the third year? Come on, guys, quickly let me know what should I enter for the third year? Yes, the previous year's figure multiplied by 1 plus 30%. So 1 plus 30%. This is what it will come down to. And similarly, for the fourth year, previous year's figures plus 1 plus 40%. So this is how much the maintenance cost is going to look like for all these years. Do you all follow? No, Ruben, it will not be 15,600. We have to keep applying the inflation for the previous year. So for the second year, the immediate previous year was the first year. For the third year, the immediate previous year was the second year. So we will always pick the previous year's figures. Okay. Now next, we are going to have a look. Do you all follow till here, everybody? Till row number 5, are we all clear? Arya, Diya, Domicile, Serena, Shruti, Shrishti, Roshan, all good? Melanie, Pari, so far so good, everybody? Okay, now let's move towards the next item which has been given to us, the other running costs. So I type in over here, other running costs. So the other running costs will be 20,000 in year 1. So minus 20,000 over here. And then they are going to increase at annual rates of 5% in each of years 2 to 4. So same what we will do over here. Previous year's figure will be increased by 1 plus 5%. Same way for the third year, you will take the previous year's figure, 1 plus 5%. And then again, previous year's figure, 1 plus 5%. So this is how much the other running costs are going to look like at this particular project. Okay, you all follow till here? Row number 6 also? All right. Now, you people, let me know what is the next number that I should be calculating. What number is needed to come to the final answer of NPV calculation? Anything else that we are missing out on? Yes, scrap value. So we will do our workings for the scrap value. I can create my workings over here on the right side. So this is my working note. And here I am doing my workings related to scrap value. Now, what is the information telling me? Accounting depreciation is charged at an annual rate of 20% reducing balance. That means in year 0, I am starting at the value of $300,000. Then in the year 1, the depreciation amount will be 20% of this figure. That means 60,000 will be charged as depreciation. So the written down value at year 1 in the books of accounts will be 300,000. From that, 60,000 depreciation has been charged. So 240,000 is what will be the value after end of year 1. Then if I keep doing the workings further, second year, I'm again going to charge depreciation. Can you guys let me know how much will be the depreciation in the second year? What formula should I enter? Depreciation for year number 2? Should I charge it on 300,000 or should I charge it on 240,000? Let me know just this much. I should charge it on 240,000 because depreciation is charged on the written down value. So 20%, that means in the second year, this is how much my depreciation will look like. Then written down value at second year will be, from this value, you take away this much. So this is how much my written down value looks like at the end of year 2. Now this project we are going for 4 years. So far I've done the working for 2 years. Again in the third year we will charge depreciation. So in the third year the depreciation will be written down values 20%. So this is the amount that I will charge for the depreciation. And here the written down value at third year will be, this was my value earlier. I charged this much of depreciation and this is how much it's going to look like. Now it's told to us that the vehicles would be assumed to be disposed of at the end of year 4 at a disposal value to their carrying amount at the end of year 4. Now guys, what we have learned that we do not charge depreciation in the last year, that is for the purpose of tax calculation. Here, are we doing our calculation for the purposes of tax? Yes or no? So will we follow the rules of the tax authorities? If I'm not calculating for tax, I do not have to follow the rules for the tax authorities. Now you people let me know, according to the accounting policy, do we charge depreciation in the last year according to the accounting policies? Yes, we do. So here the working we are doing on the basis of our accounting policies. So will we charge depreciation over here? Yes or no? Yes, we will. So the depreciation we are going to put again for the fourth year depreciation. So that will be again 20% of this figure. And then the residual value I will get, this is my scrap value, which I will include in my workings. This is the difference between these two numbers. So this is how the workings actually look like. Is everybody clear with how we calculated the residual value? If you people have any queries in any of the steps, please let me know. If it's clear, please write clear in the chat box. Clear, everybody? Okay, great. So now I use this number as it is in my final working. So this is my scrap value. And when am I going to receive the scrap value, guys? Under which year should I plot this number? Yes, I will plot this number under year 4. So here I put an equals to sign and I will link it to my cell number K13 so that when my examiner checks my answer, they will automatically know I have not cheated this number from any place. I have calculated this and I have shown my calculations on the other side of the screen. So I can also leave out a note over here with my final answer, I can leave out a note. The note can say that the depreciation is not included. Depreciation is not included in the calculations above. Calculations above, since it is a non-cash item. Since it is a non-cash item and hence is irrelevant. So because the requirement specifically asked me to show clearly how the costs are treated, so for the other costs, I have already included them in my calculations, and whichever cost I am not including in my calculations, I have put up a note like this over here. You people will be able to write such a note like this, no fancy language, just telling to the examiner that yes, we have to we have done this treatment because of this particular reason. You all will be able to write a note like this, everybody? Yes or no? Very simple language. Okay. So now we move forward towards doing a final NPV calculation. So now I will calculate the net cash flows. So the net cash flows, I can simply use the sum formula from the 4th row till the 7th row, hit enter. Copy paste the same formula to the other cells also. You can see it has not automatically applied the formula correctly. So I will type in the formula again over here. Sometimes the spreadsheet that you guys get in your exam, it glitches. So please double check when you are copy pasting the formula whether the formula was correctly applied or not. So equals sum and then select all cells till the bottom. So this is what the net cash flows in this particular case are going to look like. Do you all follow till here? The calculation of the net cash flows? Okay, now we are going to, the last step will be to calculate the NPV. I always encourage my students to use the spreadsheet formula for NPV over here. Can you guys quickly let me know how can I apply the NPV formula? All my enrolled students already know how to use the spreadsheet formula also. Can you guys quickly let me know what is the syntax? What should I enter over here? Yes, I'll start with equal to. Put NPV, open your bracket, enter the percentage, and then I will select the cash flows. Can you guys let me know what all cash flows should I select? What all cash flows should I select from year 1 to year 4? Will I select year 0 cash flow in my NPV calculation? Will I select year 0? No, I will separately subtract it from my present value of the cash flows. Why? Because year 0 is already at today's value. The NPV formula discounts the cash flows. I want to discount the cash flows which are already not at the PVs, which are from year 1 to 4. Year 0, we are already at the present value, so no need to discount that. So equals NPV. We open the brackets, enter the rate of discount, that is 9%, put a comma, select the cash flows from the first year till the last year, and then manually subtract your initial investment. Already, because the initial investment is put as a negative figure, I will not use the minus sign again, because minus and minus will cancel out each other and ultimately give me the effect of addition. But I want to subtract my initial investment, so that's why I'm using the plus sign. So plus and minus will remain minus. So this is how much the NPV is going to look like for the company. This is going to be the final answer if the company is going ahead with the buying arrangement. Do you all follow till here, everybody? Okay. Great. So now we are going to move forward to the second method if the company goes ahead with a lease. So for a lease, again, I will set down my workings 1, 2, 3, 4, and then I'm going to see the information from the case study. So the case study tells me the vehicles could alternatively be leased for a period of 4 years with 4 fixed payments of $80,000 payable annually in advance. Annually in advance means to use the asset for the coming year. When will you have to make the payment, guys? If you want to start using the asset, you have to make the payment right now. So for year 1, company will pay at year 0. For year 2, the company will start to pay at year 1, right? So this is how the payments are going to look like. So because the payments are in advance, for year 1, you will pay the money in year 0. So what we will do is we will show the lease payments. So the lease payments will represent money going out. So I will put minus signs over here. So minus 80,000. And this payment, we are using the machine for 4 years. So we are going to make the payment for 4 years. So for the 4th year, you will pay in advance. That means the last payment will go out from the company's pocket in year number 3. Do you all follow the timing of the cash flows? Are you all clear with why we have put the numbers in under which particular year? Yes? Okay. This is something where, again, a very common area where students lose out marks in the paper. You people are in a hurry. You know this is how things are to be done. But just because you're in a hurry, you're nervous, you're anxious in your exams, you end up making these silly mistakes. So be very careful. Read the question very, very carefully. Further, it tells you under the terms of the contract, the lessor would incur all the maintenance costs for the vehicle. So I do not have to pay the maintenance cost. The other running cost for the leased vehicle would be 75% of the other running cost if the vehicles were bought. So can you people let me know what formula should I enter over here? What formula should I enter to find out how much the other running cost will be? So if I'm writing over here, other running cost, how do I do my calculation? The question is telling me it will be 75% of what I would pay if I was buying the asset. So what number should I enter over here? Very simple. The question itself has told you the treatment. Just tell me what formula should I enter here? What should I write in the cell? Absolutely right, Arya. So what we will do is we will link our previous working. So what was my previous working? According to my previous working, this was the number. Now, according to the question, I will incur 75% of this number. So I select the previous cell and I multiply it with 75%. So this is what we are going to multiply. Yes, very good, Arya. Very good, Karthike. Same working we will do for the other years also. In year number 2, I was planning on spending this much. Now I will spend 75% of it. In year 3, in the other option, I was planning to spend this much. Now I will spend 75% of it. And in year number 4, I was planning to spend this much. Now I will spend 75% of this number. So we have simply linked our workings to our previous calculations and multiplied that with 75%. Clear? Understood, everybody? It was directly given to me in the question. I did not do anything on my own. I simply followed the instructions that were given in the question. So far, so good, everyone. This is how the running cost will look like. And because it's not mentioned that running costs will be paid in advance, I am assuming that running costs will be paid normally, that it happens at the end of the year. If by chance it told me that the running cost will also be paid in advance, then under which years will I start to plot the cash flows? I will start from year 0. Very good. Just like how I did for the payments. Right. Very good, guys. Crystal clear you guys are on this. So this is what the cash flows look like. Any other thing which you guys feel we should add before we go to the final calculation? Anything else which we are missing out on? Or shall we go to the final workings? No, all is done? Okay. So let's calculate the net cash flows over which we will apply the formula. So you can simply use the sum function, or you can, because there are only 2 rows, so you can use the plus sign also. Okay, so this is what the cash flows look like for the company. Now I can simply find out the NPV. Again, I'll use the same syntax as I had used earlier, 9%, comma, selecting the cash flows from the first year till the last year, and then manually subtracting my initial investment. So this is how much the NPV will look like in this particular case. Okay. So this is what my final answer looks like. If you guys want, you can highlight this final answer, bold, and okay. And same we can do over here also. So this is how much it will cost if the company buys. This is how much if it will cost if the company takes it on a lease. So guys, can you people let me know which option would be beneficial for the company? Leasing is better. We are saving on some amount of money. How much is the saving? We can calculate that also. If we buy, this is how much we will pay. If we take it on a lease, this is how much we will pay. So there's a saving of roughly 3,959. We can round it off and we can say roughly the business is going to save on $4,000 if the company goes ahead with the leasing arrangement. So I will write it down. My comment should be there so that my answer will be complete. I will say that AgeAid should go ahead with leasing arrangements for the vehicle, as it will reduce the cost, or you can say as it will cost lesser by $3,959. $3,959. Okay, so this is the comment that I will finally conclude with to get the complete 10 marks that are available over here. Easy? You all are clear with part A? Okay, great. Now let's move forward to the next requirement. So the next requirement wanted me to discuss 2 reasons why AgeAid will lease the vehicles rather than buy them. So you have to give 2 reasons other than. In the previous question, we've already shown that money-wise it will be beneficial to lease only. But now you have to give 2 other reasons than the cost why it will be better to lease the vehicles. So can you people again, the reasons that you try to think over here, try to make it linked to the case study. What could be some of the reasons why it will be better to have, the leasing arrangement? One thing is directly given to you in the case study also. Janani, cost efficient, if you write this point, you will score 0 for this point. Can anyone tell me why we are going to get a 0 for writing cost efficient? Can anyone tell me why we will get a 0 for writing cost efficient? You guys know? Yes, absolutely right, Arya. Janani, the question has made it very clear that you have to talk about the reasons other than the costs. Other than the costs, you have to tell. Think of some answers. One hint is directly given to you in the case study. One hint is directly given to you. I'm giving you people 2 minutes. Try to think, and then we will discuss this together. Janani says charity. What do you mean by charity? Giving you people 1 minute. Try to think about it. Then we'll discuss. Okay, great. One point has been made by Shruti that the service support will be provided by the person who will lease the vehicles to us. It's clearly mentioned in the case study. Under the terms of the contract, lessor will pay for all the maintenance costs. So that means all the maintenance related services will be provided to me by the lessor only. So what will be the benefit over here? That we will have a reliable maintenance services. So this will reduce the risk of any unexpected maintenance costs that may arise. If there are any unexpected expenses, naturally the lessor is going to take care of it. So yes, this is a very good point. This is linked to the case study also. So I will put down the subheading for this, then we'll discuss the structure. One thing I'm mentioning is the service support, or you can say maintenance support. Maintenance support. One more point try to think of. Great point, Shruti. Good job. Jayati, again, for writing this point, you're going to score 0 over here. Jayati says, cannot claim tax allowable benefit on the depreciation. Even if we were buying the vehicle, do you think we could have claimed the benefit? Can the charity claim the tax benefit if they are not paying taxes in the first place? You people would have studied this under the conditions, right? If the company is not paying taxes, how will they get the benefit? Benefit is only there for the taxpayers. So this point will again fetch you 0 marks. Think of more reasons. Okay, I'll give you people a hint. If the company goes ahead with the buying agreement, how much money do I require upfront right now at year 0? If I go ahead with the buying arrangement, I require $300,000 right now upfront. But do I require such a big amount in the leasing option also? No. So what does it mean? The liquidity position can be better for the charity. Rather than spending a huge amount of money in one go, I can divide it into smaller payments, smaller regular payments. So we can budget for these payments, and the money that comes in from the income, the donations, etc. That money can be used to pay off these payments regularly rather than spending a big amount. Or, if we have to go for the purchasing option, maybe the charity may even have to take a loan also. So it will be much, much beneficial that we go for the regular payments rather than spending the money all in one go. There's one more benefit that is possibly, that we can possibly write over here. Anything which you people are able to think about? This is again a point which you have studied in the reasons. If you guys want, you can open your notes also. Disposal, Shruti, this point is not very applicable over here because disposal is mainly we're talking about whenever there are any special rules for disposal. There's no such mention over here, so it won't make much sense writing about that. I'll give you people 3 points to choose from. You can explain any two. Think about a scenario where your vehicles okay, Arya and Kartikeya says we only need the vehicle for a short period. Yes, okay, we can talk about this. So I can say mainly about the replacement of the vehicles. What point can I make over here is if the vehicles become unreliable or if they become obsolete, then my lessor is going to be responsible for changing for those vehicles. Or once the lease agreement comes to an end, I can automatically opt for another lessor, which will have the more recent vehicles. So the replacement of vehicles will be easily possible. But if I go for the buying option, then I will not be able to switch my, vehicle very easily. I have to buy a new vehicle, sell my old vehicle. So it will not be very, very easy. So replacement of the vehicles would become easy. This is the another point which you people can talk about. Now, broadly, these are the points which are possible. If you people are able to think of any other relevant points also, you may write about that. But now I will tell you people how you can structure your answer. So I would tell you people follow three points approach for your explanation. The rule that you guys should follow is, firstly talk about the point. Firstly, talk about the point. What is the point of explanation, or what is the advantage that you're talking about? Then you try to explain how that thing is an advantage. How exactly is it going to benefit the company? And thirdly, you people should apply it to the scenario. Apply to the scenario. So if, for example, I teach you how you have to draft this point about the maintenance support, how you people can talk about this point is, firstly, we will say that if we go ahead for the leasing, so if, or you can say under the lease arrangement or agreement, the lessor is responsible for providing maintenance support, right? This is what the point is. Now, we are going to tell how this will be beneficial for AgeAid. So I will say that leasing would be beneficial, or you can say leasing would transfer the risk of any unexpected maintenance expenses to the lessor. And what will happen with this respect is, if we had purchased, if AgeAid purchases the vehicles, then what will happen is it would have to bear any unexpected repair costs, which will make the expenditure difficult to predict, So you can see I have only used 3 to 4 sentences over here and have clearly linked my answer to the case study also. Easy to write such an explanation. Would you guys agree with me? No fancy, sophisticated language, just a clear application of the concept and a link to the case study also. Right? Same way we can frame the explanation for the regular payments point also. How can we explain this particular point? I can simply say over here that when it comes to the leasing, under leasing, the AgeAid is going to have regular predictable payments, which will make the cash flows easier for AgeAid. Now, this is important. How? Because it tells you, according to the question, according to the information that's been provided to us, AgeAid receives regular donations. So using those donations, these payments can be conveniently met. Otherwise, if we go for the buying option, it will require a large amount of initial cash investment, which could put a pressure on the liquidity of the company, and possibly there might be a requirement for the taking a loan. So this is how we can put the explanation for the regular payments. So let me put in the explanation over here. I would simply say that under leasing, AgeAid will have regular and predictable payments, which will make it easier to create cash budgets. The regular donations that AgeAid receives can be used to make the payments of lesser amounts spread over few years. Under, or we can say on the other hand, buying option would require a huge initial investment upfront, which might hamper the liquidity position and may create requirement for additional funds. So this is the explanation that I can draft for the regular payments point, right? Clear? You people will be able to frame answers like this on your own? Yes or no? So far, so good. Same manner, we can explain about the replacement of vehicles point also. How can I say? So I can simply say in this case that when it comes to the lease arrangement, lessor will replace any unreliable or obsolete vehicle. But if that happens under the buying case, then AgeAid will have to do the replacement. So, it will be easier if the company is taking it on a lease, because then the lessor will be responsible for providing the replacement. Right? You people will frame this on your own. Shall we head to the next requirement now? So far, so good, everybody. Can I get some more responses? I've only heard from Arya and Shruti. Others, are we good to proceed forward? Okay. Now, moving forward to the next requirement, next and the last requirement for that matter, we have to explain for 6 marks the 3 E's framework and how this can be used by AgeAid. So again, the 3 E's which we have studied. Can you people quickly throw in the names of the 3 E's which you people have studied as part of the value for money framework? What are the 3 E's that we have studied? Economy, efficiency, and effectiveness. What is the keyword for economy, guys? What's the keyword for economy? It's the cost of your inputs. So you try to minimize the cost of your inputs. That's the keyword. And if I talk about efficiency, what's the keyword with efficiency? It's the maximization of output to input ratio. You want the most of the output with the given input. Yes, absolutely. And what is effectiveness? What's the keyword for effectiveness? Yes, it's about the ultimate objective. Very good, guys. So the same thing we are going to first explain, and then we will link how AgeAid can use this. So we will first of all start writing our answer by saying that the 3 E's framework, or we can say the 3 E's under the framework are economy, efficiency, and effectiveness. So this is like my opening statement, and then I will talk about the E's one by one. So first I will talk about economy. Now, within economy, I'll first give a brief explanation. So economy is concerned with minimizing the cost of the inputs. So can you guys now link it to the case study? What would be the inputs for a charity like AgeAid, where they are providing the services for the elderly? What could their raw material or the inputs look like? They are providing, the day centers where the elderly people can attend and participate in the activities. They are, coming up with hot lunches. So what would be the inputs that they are using? If you're running a charity like this, imagine what kind of expenses, what are the things over which you'll be spending the money on? Come on, guys, you're better than this. Think about it. If you're running a charity like this, you're providing the lunches, regular hot lunches. So the food, yes, The raw material that you're purchasing for the food, that is where you're going to spend upon the ingredients. Definitely, when you're trying to reduce the cost of the ingredients, now this is about the food that we are talking about. So we have to maintain a certain level of the quality also that the raw materials are going to offer. So if I talk about economy, we'll say that this is about providing the resources or providing the service for the lowest cost that is possible. Now, when it comes to AgeAid, it will mean that the meals that they are offering, they should be of the acceptable standard, of the acceptable quality, while using the cheapest material possible. So how will I draft the explanation? I will say that for AgeAid, so economy is concerned with providing the acceptable quality of service while minimizing the cost of the inputs. So for AgeAid, this would mean to provide the lunches of a certain acceptable nutritional quality while trying to purchase the ingredients as cheaply as possible. So this explanation for economy is worth for 2 marks that we are writing the answer. Do we all follow till here? Easy? Okay. Now next we are going to talk about the efficiency, and then we will talk about the effectiveness. So when it comes to efficiency, we were just now talking about that how this is related to providing the maximum output. So I'll first start off with the basic definition that efficiency means using minimum of the resources to provide the particular level of service. So efficiency is about using the minimum level of inputs to provide the services of the maximum level of output. Right? This is the basic definition. And the next thing is I will apply it to the context of AgeAid. So guys, can you people let me know how can I link it to AgeAid? What would be the inputs that they are using, and then what output are they actually generating? How can we link it for the perspective of AgeAid? Think about it. This is where you're going to actually fetch the marks. The normal explanation will not give you a lot of marks, not enough to clear. Yes, the lunch is prepared. Who is preparing the lunches at the charity? Staff. What do we call the staff? They are the volunteers, right? So the volunteers who are involved in the process of preparing these lunches. So for AgeAid, we have limited number of volunteers. We have limited number of vehicles. So with the limited resources that we have, how many hot meals can we actually provide to the people? So for AgeAid, what this is going to mean is the charity is going to be having a constraint with the limited number of volunteers, limited number of vehicles to deliver the meals. So here, what would efficiency be? Efficiency would be to provide the maximum number of daily hot meals possible given the limited amount of resources. So AgeAid will have a constraint of limited number of volunteers who prepare the meals, and also limited number of vehicles for delivery. Efficiency would be measured by delivering maximum amount of daily lunches as possible given the limited resources. Right? So this is how I will define for efficiency. So far, so good. Shall we now talk about the effectiveness? That's the final outcome. Yes. So the final outcome for a charity, guys, what would the final outcome look like? Do we know in the first place what is the final outcome of this charity? What do we want to achieve? We want to provide the nutritional meals to the people, the elderly people. That's the objective. And we also want to offer the facilities in the daycare centers, right? So the facilities that we offer, the health, we have to cater to the health issues, the mobility issues that the users will have, and creating activities which will help them participate, enjoy, and they want to attend those activities regularly. So that is how the effectiveness is going to be measured. Yes, more people get the food, improve nutrition for the elderly people. Yes, absolutely. So I will start off with the very basic definition of effectiveness. So we'll say that effectiveness measures whether the we can say the organization is actually achieving the objective it had set. This is the basic definition. And now we are going to relate it to AgeAid. So we will say that this will include providing nutritional meals, and then this will also mean to provide facilities and providing facilities in day centers and cater to the health and mobility issues of the elderly people, and creating activities and events in which the elderly want to participate in. Right? So this is how I can explain the effectiveness. Clear? Easy to link the answer to the case study. Oh, you might not be able to see it. Yeah. Clear? So far, so good, everybody? Okay. So with this, we come to an end to the agenda that we had planned for today. Now, tomorrow's session, we will be covering the second Section C case study that we are left with. And we are also going to take up the remaining Section A questions that are also published as part of the March-June 26 examiner's report. So that is what we are going to cover as part of day 3. I'm going to confirm to you all what the timings of the session are going to be very shortly over the group. If you people have any queries, please let me know. I'm here for another 2 to 3 minutes, and then I'll see you people on the day 3 of the webinar. You're most welcome, guys. Most welcome. If you people do not have any queries, then you can feel free to drop off from the call. Thank you for attending the session, everybody. I'll see you people the next time. Take care. Bye-bye. Keep practicing.